This video is all about the housing bubble. Is there one? When is it going to burst? What should you be doing about it? How is it going to affect you? And I promise you, you've never seen a video like this on this topic, and you certainly haven't seen it from me, because I took a whole bunch of different components, interviews, things I've said in the past, and there's a massive overreach in the real estate market, some important articles and lines from commentators that I want you to see, and a lot of charts. So you're going to get a really clear picture of the housing bubble and how things are going and what you should do about it in this video. For many of you, this is your very first time here. My name is Peter Leeds, and I am the small stock specialist. You might ask yourself, why small stocks? Because they produce the biggest gains, if you know how to find them. And please understand that nothing in this video or anything we put out ever is intended as personalized trading advice for you. To truly understand this housing bubble and how we got to where we are now, it's important to look at a lot of the factors that were acting as a wind in the sails of home prices. And what you'll notice that they all have in common, most of them are all diminishing in their influence on pushing prices higher. For example, there's always been a tight inventory for a while now. Not enough homes for the number of people looking to buy them. But what did I tell you? That the supply will normalize and naturalize itself. As more people are selling the homes, all of a sudden that tight supply will become less tight. Prices will come down not because of building new homes to meet the demand, but because the demand itself will diminish. There will be a lot more options. People will be selling their homes as prices have gone so high. Now we're at the first point where it's turning the corner and starting to come down. Most people now, unlike 6 months ago, most people now expect prices of homes to decline, not increase going forward. A lot of that has to do with the Federal Reserve raising interest rates, making it more expensive to afford a mortgage, to pay the mortgage you have, to be qualified for a mortgage. And as you know, the stock market has done very well over the last few years. We haven't had a recession in 14 years. Even cryptocurrencies have done pretty well. It's a wealth effect. There's a lot of people who see their home prices increasing, and so they're more willing to be active in the economy. Stocks, investments like cryptocurrencies have done well, so people are feeling wealthier. And of course, we had all this unbridled monetary creation. And of course, there were the government stimulus checks. The government's giving us a fish instead of teaching us how to fish. And with recent history, there's recency bias. So there's fear of missing out. And that helps encourage people, motivate people to drive them towards buying more homes. And that engendered some increased motivation to jump and buy a new home, pay over asking price, do whatever you have to do to get one of the homes in a limited inventory. And recency bias shows you that the market's been going up for so long, people are expecting that if they buy a house, even at inflated prices, maybe they'll make money on it anyway. Maybe these prices are going even higher from here. And with a lot of the shifts in the working habits of people in the last couple of years, that's caused migrations, people moving from one area to another area. So it puts more pressure on the buying demands in certain areas and less in other areas. People were moving out of the city and working from home in the suburbs. But I would suggest that don't focus on the price. Everyone says, here's the price of a home, an average price of the home. It's going up, it's going down. They're watching the prices. But if you want to get ahead of the game and try and understand why I would have seen this coming so long ago, is you watch the meta messages. You watch the little indicators, which very few people keep their eye on. Most people just watch the price. What you want to do is look at the trends and things like what percentage are people overpaying for a house? How much over asking price? As that percentage is extreme, that means the market's a little bit overheated, but as it starts squeezing down, people are paying less above asking price. That's an indicator that things are shifting, the tides are turning. You watch how many days a house is on the market. As that becomes less and less, that means the market is overheated. As it then extends and the average house is on the market for longer, that's telling you something. This is all telling you a story. And if you want to get really granular, you look at the number of bids per home. When a house is for sale, how many offers do they get? If the average home for sale gets 5 offers, and that becomes 4 offers, that becomes 3 offers on average, that means the market is cooling off. And to go all the way down the rabbit hole, look at how many showings a house has once it gets listed. House goes for sale, you've got 12 agents coming through, leaving their card on the counter. That's telling you it's a hot market. And then as you watch and see that fewer and fewer agents are going to each new listing, that's telling you the market is also cooling off. Watching things like this is how you can know ahead of time when the market's turning around. And that's why I was able to say things like this a while back. But my premise is unchanged from many years back. My premise is that it's all going to come down together. You're going to see digital currencies declining in value, real estate declining in value, stocks declining in value, bonds declining in value. It's going to be a pan-ultimate wipeout. And this article I want to point out came out on CNBC literally a few hours ago. From Diana Olick. Mortgage demand falls to nearly half of what it was a year ago as interest rates continue to rise. And in that headline, you've got the whole story right there. That's exactly what's going on. I think most of you understand that. But we're going to go even deeper down this rabbit hole. And in this article, it goes on to say, refinance demand fell another 8% for the week and was 68% lower than the same week 1 year ago. Mortgage applications to purchase a home fell 3% for the week and were 14% lower than the same week 1 year ago. Do you see the shift? The whole trend is tipping a little bit slowly, but it's going to pick up momentum. Am I calling for a housing crash? I believe there will be one, but that's not what this video is about. I'm just trying to help you understand what to look at and some of the things you can do to land on your feet as this real estate bubble bursts. The past week's data spotlights a market still struggling with the shortage of inventory and rising prices, says Realtor.com senior economist George Ratillo. However, there are clear green shoots, and the moderation in the upward price trajectory is an indication we are moving toward more balance. Yes, absolutely we are. I just don't think that the person in this article understands what that balance means. And if you work for Realtor.com, you have a vested interest to always look at the bright side of the real estate market. You're never going to get a real estate agent saying, yes, we're going over the cliff now. Carrying on with this article, he said, these factors are especially important this year as families are facing significantly higher bills from food, clothing, and gasoline to airfare, medical costs, and daycare. That's a good way to sum up the added pressures people are having in this inflationary environment in this uncertain economic time. People are taking on a mortgage, and then a few years later, they're realizing it's getting harder to pay this mortgage. In addition, higher rents and home prices are further pinching take-home paychecks, which, although rising at a solid clip, are not keeping up with the pace of inflation. Encouragingly, data from the past few weeks are pointing toward more housing options, better balance, and more approachable prices later this year. What a gentle way to explain that house prices are coming down, more people are selling, people are paying less over asking price, people are bidding on homes less frequently, houses are staying on the market longer, and he puts some lipstick on the pig and explains it as he explains it. Better balance and more approachable prices. More approachable prices. They're lower. Prices will come down. That's what he could have said. And as I mentioned earlier, as most people are expecting house prices to come down, they're going to wait longer, not have the fear of missing out, not overbid, not compete for homes as much. But I'm going to relate this closely to how it is with inflation, an indirect effect, which just happens to be the namesake of this video, the indirect effect. There's an indirect effect because people are expecting house prices to go lower, which is different than it was 6 months ago. But to take it into consideration in terms of inflation, to give you an example of how this works, when the media is talking about inflation, every water cooler conversation you're talking about inflation, you run into somebody at the grocery store, you have small talk, which brings up inflation. Prices are getting greater. People are feeling the pinch. And it keeps reminding people again and again until it sinks deep within their subconscious. Even if they wouldn't have been so negatively affected by inflation, they're going to be paranoid about it. They're going to spend less money because everyone's talking about it. The media is cheerleading inflation almost. And eventually, the velocity of money will, which is already incredibly low, will continue to get lower. It's the same thing. With inflation, it's got an indirect effect, which is making things worse. With real estate prices coming down, it's an indirect effect, which is going to make things worse. What happens with real estate is that once the selling begins, then it just engenders more selling because there's more inventory, more people looking to move out of their house, more people who are looking to buy have a greater choice, a greater selection. They might find that. So while rising real estate prices have added momentum to the move, they will also act in the exact opposite way when they're going lower. Well, let's get into some charts. This is all transactions house price index for the United States. This is from the St. Louis Fed, and the way that they do this, they started in 1980, and in quarter one of that year, they started the count at 100. And then it's all in relation to that. How much greater or less is it from 1980? And you can see that it's pretty much only gone up. And right now it sits at 557. That's the Fed's all transactions house price index. This is the monthly supply of houses in the United States. And you'll notice that it was way more extreme in the global financial crisis. But here's the thing I want to say. Everyone is saying, looking back to the GFC, they're saying, oh, it's going to happen again just like it did in 2007, 2008. But I want to encourage you to look at it the way that I see it. I believe that these are two completely different things. I know that history can be a great teaching guide, but people are misunderstanding that this housing crisis is going to be anything like the other one. All the factors causing the previous one are different. This new housing bubble, which will be a housing crisis, is completely different than the global financial crisis. The causative factors, the situation that people are in, is completely different than 2007. This is median sales price of houses sold in the United States, and going back far enough, it looks like it's a great uptrend, and it has been. But what do you notice now? For the first time in many, many years, we've seen the first dip. We've seen the first decline in the median sales prices of houses sold in the United States. And a great time to get in on a trend is when it first begins, especially if you see it coming ahead of time. And once it turns, you act. What are some ways that you could act? For example, if you have a house, now might be a great time to not have a house. If you're looking for a place to live, now might be a great time to rent instead of purchase a home. And I always say that don't worry about house prices if you have a home that you're living in. Everybody needs a house to live in, but there's a timing thing. You don't want to buy a house in the last year. But if you buy it in a few years, it'll be a lot cheaper. You get more house for a lot lower price, in my opinion. This is the monthly supply of houses in the United States. And you can see right here on the chart, that is showing you some inventory constraints. This is basically just like the reserve life index I always talk to you guys about. When you have any kind of commodity being extracted, there's only so many years until that resource runs dry at the current extraction levels. It's the same in this chart. How many days until all the available homes are absorbed by the people looking for a home? How many years and months until this supply of homes gets exhausted by people coming into the market? The median home price in the United States is $374,900 as of the second quarter of 2021. Home prices increased by 16.2% from 2020 to 2021. That's an incredibly strong climb. Nothing crazy, but it's quite respectable. The median home price increased by 416% from 1980 to 2020. The Zillow Home Value Index puts the typical home price in the United States at $293,349. That's all according to Google. And this is from an article from Better Dwelling that I really needed to show you. House price to income ratio. The house price to income ratio is a fundamental of housing affordability. It's the ratio of the market price of a typical property as a share of household income. Rising ratios means home prices are outpacing incomes for growth. This is considered a deterioration in housing affordability. Falling ratios means incomes are outpacing home prices, an improvement in housing affordability. But we know that housing affordability isn't getting much stronger. Cross-country comparisons need normalization. So the OECD created an index. They set 2015 at 100, and the indexed value shows the change from that period. For example, if the index is 110, home prices have grown 10% faster than household incomes since 2015. Already unaffordable homes have increased in price a lot faster than people's incomes, making it less likely that people will be able to afford a new home, or the home that they currently have a mortgage on. An index of 90 would mean that incomes gain 10% on home prices. The idea is to measure how fast these metrics are changing to address them before they turn into a problem. And here's a chart of which nations are houses most overvalued. Number 2 is Canada, where I live, and home prices have already started falling as much as 33% in some areas. Number 1 is the Netherlands. America is down here at number 12 or 13 or so. But even so, there's more nations where the affordability is worse. That doesn't mean it's anywhere sustainable here in America. And here's an article from Realtor.com from Claire Trapazzo. Claire is a wonderful name. My daughter's name is Claire. Are we approaching bubble territory in the U.S. real estate market? Fast rising home prices? Check. Out of control bidding wars? Check. Investors flooding the market? Check. Over the past 2 years, the nation has watched worriedly as home prices seemed to hit a new record high every month. Many buyers have been offering 6 figures over asking prices to snag properties. It's been uncomfortably reminiscent of the run-up of the housing bust that blew up the world's economy roughly 15 years ago. No, it isn't. It's a completely different thing. It's not apples and oranges. You're comparing fish to elephants. And people are saying, well, look at the lessons we learned last time and look at how it's similar. You can't ignore history, but a lot of the factors which are causing this housing bubble have nothing to do with what happened in 2006, 2007, 2008. Completely different world. Even looking at any of these charts I'm showing you, it's all completely different. There's less speculation. People have a lot more debt now. Interest rates are going to be increasing now. We're going to be in a recession. People's psychology has already shifted. The fear of missing out can evaporate in a week, and that's happened now. And as housing prices begin to decline, it will only engender more declines. This is dominoes. It's not a bubble bursting. It's not going to explode. It's going to be a long, drawn-out decline lower. And is it because they're raising interest rates? That's what everyone will tell you in the media. This would have happened either way. It's going to be exacerbated because they're raising interest rates. That's how it starts. That's how the market starts cooling off. First, it'll be the refis, and then next, what will fall will be the applications for a first-time mortgage. That's how you're going to see it turn the corner and start going the other direction. There's a lot of arguments, though, that there's a limited supply, a ton of money floating around. A lot of people are moving. Meanwhile, the dollar's value is declining, and so it's taking more dollars to buy the same house, and so it's pushing prices up. I get all that. But I think that the way we've overreached so much that first, before we go to $1 million for a $20,000 house because I kill the value of the dollar, before we get to that point, what I think is going to happen is that there'll be a lot less heat and smoke around the real estate market. A lot of people will start seeing this as a good opportunity to cash out of their house if they're thinking about doing it. As the market has progressively heated to a boiling point, most real estate experts swore up and down that housing market wasn't in a bubble. Mortgage interest rates were so low in the unprecedented mid 2% range that buyers could afford the inflated prices. Lenders were no longer making bad mortgages that could trigger another foreclosure crisis. Are you sure about that? In this time around, a housing shortage that has reached crisis proportions has resulted in many more buyers than properties for sale. Just the opposite of the 2007-2008 pre-crash conditions. This market could support the frenzy, they explained. You see, the risk here is that they're saying it won't be like last time because things are different. And what I'm saying is that things are different. It's going to be a new thing. But the result to you will be just the same. And understand that as this housing bubble deflates, that's going to take away the last of the wealth effect. Stock markets had a big wealth effect. The rising real estate prices had a big wealth effect. And you know my premise is that it's all going to be coming down together. Mortgage rates soaring to their highest point in more than a decade, hitting 5% last week. Many of the same experts that were saying that there was no bubble are now warning the housing market might be approaching a bubble if it isn't in one already. They could just watch these videos and know months, years ahead of time what's going on. But now everybody and their grandma's talking about it because it finally is clearly obvious. My role is to tell you things that are going to be clearly obvious before they're clearly obvious so you can adjust to it and make the best decisions for you. Like, for example, maybe sell your house at the top of a market rather than buy your house at the top of a market. There's only so much that home buyers can afford before they're priced out of the market. In March, when rates surpassed the 4% mark, the number of buyers applying for mortgages fell 5%, according to the Mortgage Bankers Association. Nationally, buyers are paying about 42% more in their monthly mortgage payments for the same house today than they did a year ago. Let that sink in. 42%. And under the guise of interest rates will go up even higher, which means it'll get even worse, and there's inflation. You're paying more for gasoline to drive to your real estate agent's office. The potent combo of rising home prices up 14% year over year in March and escalating mortgage rates, which rose nearly 2 percentage points, have added hundreds, if not thousands, of dollars a month to those mortgage bills. Let me ask you, do you think that this will get better? Do you think that this will go away on its own and that house prices will just resume their upward climb? If you believe that, I'd be cautious and I would say good luck to you. I think that the curtain's being pulled back on home prices, on the stock market, even in cryptocurrencies. A lot of the altcoins I'd be very cautious with. And that's on top of what potential buyers are spending on everything else. Rents are up about 17% year over year. Inflation's running at 8.5%. Gas prices rose about 40%. Many folks are simply tapped out. No one wants to sell their house at a loss. The thing is, the situation's setting up that we won't have a choice. There's people who will literally not be able to afford their mortgage and they'll have to sell their house because of that. They're not going to be holding out for top dollar. They're going to take an offer when they get one. How can the system handle skyrocketing home prices, mortgage rates, and rental prices simultaneously? Some believe it can't. But I'll just give you a spoiler alert. The system, that they say, cannot handle the current situation that's building and going to be getting worse before it gets better. You want to see home prices come down? Keep your eye on it. It's going to go slowly at first and then really quickly. Everyone is going to be running from one side of the raft to the other side of the raft. And as I've been telling you, keep your eyes on what you're looking to purchase. If you're looking to buy a home, watch what you want to buy. Wait till the prices come down. And back to George Orteo, manager of economic research at Realtor.com. Some markets will see a correction if mortgage rates continue to rise, in which sales drop and prices will follow. But I don't expect the market to see a huge crash or spike in foreclosures, he adds. It won't be like a huge crash. It'll be a long drawn out decline lower, a trend lower. Inventories will build. The number of active prospective home buyers will decline. So sure, it won't be a huge crash, but he says there won't be a spike in foreclosures. There will be a lot of foreclosures, especially as interest rates go higher. There will be foreclosures in real estate. There will be foreclosures in corporations and municipalities. A tsunami of foreclosures is inbound, and it's going to be affecting mortgages more than a lot of other things. It all comes down together, but mortgages will be the one taking the biggest hit now. Retiu anticipates prices could fall 5 to 15%. Prices are already tumbling in places like Toledo, Ohio, and Rochester, New York. Now here's a really important part from this article. This is the most important part. But buyers expecting some price relief will likely be disappointed. Even if prices do fall, home buyers will still be saddled with higher monthly mortgage payments. Rates have risen so much so quickly that they will likely more than make up for the lower prices, costing home buyers even more money. So prices are coming down, and it's still going to cost you more for the mortgage and the lower price home. In more desirable communities with plenty of high-paying tech and manufacturing jobs could see prices still continue to rise. Like in, Austin, Texas. You're now starting to see people stretch their budgets, says Ali Wolf, chief economist of building consultancy Zonda. The market looks more frothy than it did just 6 months ago. You see? It's good to know it 6 months ago when I was telling you, but it's okay if you want to just learn about it when everybody else knows about it. What you want to do is go your own way. You want to be upstream. You want to be ahead of all this, which is a great reason why you're going to want to subscribe to this channel.